All right, we're back right now at 14 after the hour. We are pointing to that lower open based on the equity index futures. A lot of concerns coming out of the ongoing Bear Stearns story. Also, what's been happening on the credit side of the ledger. So that in mind, let's welcome Drew Kanaly. He's chairman of Kanaly Trust, helps manage over $2 billion. Joining us this morning from Houston. And Drew, good morning. Thanks for taking some time for us.
Good morning, Ellen. Thanks for having me.
A lot of concerns in the market over the past few weeks having to do with interest rates, what's happening at Bear Stearns, the ongoing story having to do with subprime. Stocks pointing to a lower open today, continuing basically declines for the week. Is your tone generally positive or negative for stocks at this point?
Still very positive. You have to remember that the five big economic drivers are still in place. We still have good trade policy. We still have good tax policy. We still have good regulatory policy. We still have good Fed policy, actually probably even getting better. And we still have plentiful credit. So everything's still in place for a good market at this point.
All right, well, let's focus in on your last 2 points, which really have to do with interest rates, because what we've seen over the past 2 weeks is investors really sensitive to and concerned about rates moving higher. Seems like you're not as concerned.
Well, what you've had is just sort of rates around the world move up a little bit, so you've got a little credit competition going on, but certainly nothing that's inflation-driven right now. And you can still look back to the 90-day T-bill, and it's still indicating that at some point in the future, the Fed's going to have to cut interest rates. The dark clouds forming, however, are sort of what we're kind of seeing right now from the Blackstone tax and sort of the just overnight, we want to try to stop the IPO coming out of Representative Waxman. Those are sort of two dark clouds. They're off in the distance, but investors should be paying attention to the road signs going forward.
All right, I just want to ask one more thing about potential headwinds, and certainly the Bear Stearns story has broader implications. A lot of folks talking about that. Why does that not make you more concerned about what could potentially happen as a fallout, as a follow-up to this story?
It still doesn't disrupt the big five I enumerated before. Credit's still going to be available. There's plenty of cash in the market. This isn't going to stop the present positive economic environment. What would slow it down is a change in regulation, such as changing IPO rules, okay? Regulation on the fly. That would cause credit to or capital formation to slow down. If they started increasing taxes or taking away incentives for investing, that would upset the apple cart right here.
All right, so let's talk about that Blackstone IPO. What you're talking about is this effort in Congress to basically have the firm pay 35% tax rate rather than a 15% capital gains tax rate. Is that perhaps why the Blackstone IPO today is not creating more euphoria in the market? Because typically it seems like this is a story that would really give a boost to stocks and a boost to investors.
Well, what is really causing the markets to wonder about is who's going to be taxed next. It looks like this might be a tax that will go through because there's a lot of momentum for it abroad in Europe. Other regulators are looking at the same sort of taxation. The real question is going forward is, are they going to be taxing other constituencies and changing the entire after-tax return scenario for investors?
And Drew, what about you? Is the Blackstone IPO or the shares that start trading today something that you've been looking at that you want to be in?
No, not for our clients. We've been hanging around Berkshire Hathaway and very happy there. This one may look a little rich at this point, and there's other IPOs coming out on the private equity, so let's see how all those go.
All right. Now, you mentioned Berkshire Hathaway. Are you generally favorable to diversified conglomerates? Is that what you generally like?
Well, the reason why we like Berkshire for our clients is there's no leverage involved. It generally cash deals. They have a pretty good track record there, and it's a very marketable security for our clients.
Now, real briefly, I know that you're seeing value in stocks increasingly overseas. Is there a particular reason that you would pull money out of the U.S. and put overseas?
Well, it's just the relative returns overseas are looking very attractive for our clients. And so we're sort of skewing our portfolios that direction. You know, if you look at global equity in its entirety, okay, the United States only represents about 45% of total global equity. So if you're looking at a basket of returns, the United States is no longer the dominant portion of it.
All right, Drew, thanks for sharing your thoughts this morning. Have a great day.
Thank you, Alan.